It is officially done.
Okay. Listen up, everybody. I have some news. It's over. We are screwed.
The most important payroll report of your life is over. So now you can kiss your kids goodnight and thank me for generating you so much alpha in today's circus. So if you'd like to repay the favor, hit that subscribe button. But on this channel, we don't rest on our laurels, nor do we put up Christmas decorations early. So let's stop the jibber jabber, take down those early decorations, Karen, and let's go make some money this week. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a very green day. Stocks soared on Friday. Investors welcomed the key monthly jobs report that showed hiring remained robust in the US economy, guys, and this sent stocks significantly higher in the S&P 500. We saw gains across the board, but particularly in cyclicals, financials, technology, semiconductors, software, communication services, as well as cyclicals, discretionary. They were the best performing sectors today. The big names, the big boys, really lifted the entire market. And we did see some fairly muted action in stuff like healthcare, real estate, utilities, consumer defensive. So anything that was rate sensitive or defensive didn't do that well today. Along with that, we also got some good news from the Middle East, and that did calm investors, as well as the port strike. An agreement has been made there for port workers and a pay increase. And all of these positive factors resulted in what we saw today, and that was stocks coming off the lows they made yesterday and rocketing higher into today. Financials, discretionary, communication services, and technology were the best performing sectors, all up 1% on the day. And when these four sectors do very, very well, you do know that the S&P 500, the broad market's going to do very, very well. We also saw gains in energy, industrials, materials, staples as well. Healthcare up 0.1%. Two sectors that were down today were utilities and real estate, rate sensitive sectors, but the four worst performing sectors were just the defensive sectors and real estate because rates shot up in a very big way. After today's data, the market's expectation for rate cuts pulled back significantly. We were looking at a 50-50 chance of maybe a 50 basis point cut or a 25 basis point cut in the next meeting. Now it's a 99% chance of a 25 basis point cut in the next Fed meeting. So rates did go up significantly, and that is going to affect real estate, but it didn't hamper small cap gains. In fact, small caps were the best performing size segment across the value, core, and growth factors. Small cap growth up 1.48%, small cap core 1%, and small cap value up 1.19% as well. Now, large cap growth did outperform every single small cap factor. However, large cap core and value were bested by small cap core and value. But not leaving out mid caps, we also saw gains across the board in the mid cap space. Very, very bullish day across the board, and it had to do mainly with this non-farms report. The market expectation was 140,000. We got 254K. Very solid, a huge beat. The unemployment rate ticked down to 4.1%, and as a result, we saw average hourly earnings month over month and year over year tick up. So they did miss the market's expectation, but we do know that inflation isn't really a big deal. And when we have a blockbuster number like this, you're obviously going to see wage metrics tick up to the upside, and not necessarily a bad thing. That's just more money in consumers' pockets, and we saw the participation rate come exactly in line with expectations. And when you have all of these factors come together, solid macro, geopolitical tensions easing, at least for now, as well as some of the news with regards to strikes and dock workers being dovish, coming to an agreement there, stocks are going to rally. But when you look at today's price action in the context of the entire week, still a lot is left to be desired. The best performing sector by far, extreme alpha, was energy. This was on the back of the geopolitical news we got this week. And you could see that today's non-farms data really helped the market. Here on Thursday, there were only two sectors in the positive, utilities and energy, for the week. Coming on Friday, we had the XLK pretty much flat, slightly positive on the week. The SPY gained 0.26%. 1%, and then XLI, industrials, comp services, utilities, financials, and energy all gained on the week. So about half the sectors gained, half the sectors lost. The sectors that did lose were materials, staples, real estate, discretionary, and financials. So mostly defensive sectors, but today's non-farms really did lift the market and take it slightly into positive territory with the S&P 500. But let's dive into the charts. Guys, looking at the charts, look at what happened with yields. Look at the 2-year yield, up 5% on the day. The 10-year yield, 3.14%. Not even 5, that's nearly 6%. And the 30-year yield, 1.7% gain. The credit market telling the Fed, look, the economy is all right. You don't need to go on more aggressive rate cuts. In fact, maybe what's currently priced into the market is a bit dovish and we need to move yields higher. So the credit market telling us the economy is looking really good. This is a Goldilocks setup. As a result, bonds did fall. TLT slightly upbeat here in extended hours, but it is Friday. And guys, we actually saw some very weird dynamics because as yields gained, the dollar gained as well. If you're going to be making a higher yield on your cash, you're going to want to hold cash. Cash is going to do a little bit better. And that's why we saw a gain in the dollar. But if this momentum continues in the dollar, it's going to actually weigh on large cap earnings. Maybe not this earnings season, but definitely for Q4 coming up. So there's a lot of moving parts, but the movement in the dollar right now is to the upside, and that is going to weigh on large caps and mid caps if it does continue. But it's actually less important compared to what yields do. Looking at commodities, Bitcoin gained 2.68% today. Gold was largely flat. Silver up 0.66% and crude up 0.91%. Equities gained across the board. The S&P 500 gained just shy of a percentage point. Large caps up 1.22%. The IWM up 1.4%. Look at the RSP. Actually, the worst performing index was the RSP. So people were looking at large caps, small caps. The middle child got left out of the conversation. Although mid caps right here, the S&P 400 gained 0.97%. Maybe I spoke too soon. And the S&P 600 up 1.55%. Either way, with the RSP and mid caps, you get a day like this, you take those days as they come. We're seeing a little bit of muted action here in extended hours, but after the Friday, you've had a little bit of profit taking. Why wouldn't you? When you've had 122 basis points worth of gains in something like the Nasdaq. But diving into the S&P 500 and the gamma charts, we're seeing some very interesting stuff. Guys, you don't even see the call resistance up here because it moved up to the 5,900 area. Very, very crazy. We also saw some volatility compression. So we saw the gamma flip zone move up, the put support zone move up, and they're very, very tight. And this is largely bullish. Seeing the put support move up, seeing the gamma flip move up, very, very bullish. We saw the bulls bounce off this zone right here on the day, and then we rallied, closing at the highs here on Friday. But still, when we look at the weekly chart, let's go to the US 500. We were pretty much up for the week, up 0.29%, but most of the week we traded at these lows where we put in this wick, but still a positive week nonetheless. And you take those gains when they come. In aggregate, the weekly chart looking very strong, higher highs, higher lows. Not really much to say unless we actually go ahead and break this level right here. I remain constructively bullish on the S&P 500. The macro is Goldilocks right now. Rate cuts are on the table. Earnings are growing. I think stocks are just going to continue to march higher into the end of the year, into next year, but not without some volatility we might see towards the end of the month. But I do think, the path of least resistance right now is up. And the S&P 500 on the daily chart, our target right now is the 5,900 level. We're currently at 5,750. If we do pull back to the 5,700, I would look to buy those dips. And I mean, even if we pull back to the 5,650 in negative gamma, we should find support at the put support and then just bounce off from there and move higher. Everything just looks really, really Goldilocks right now. Everything just looks really, really good. There is some concerns with like geopolitical stuff, but even with the dock worker strikes, they got that wrapped up really, really quickly. Positive for markets. And I think we probably will continue to move higher into the end of the year. But guys, there will be volatility. Looking at the Nasdaq 100, we saw much of the same. The gamma flip zone moved up and still a lot of upside to get to the core resistance here at the 20,400 level. And now this is looking like a higher low relative to this low right here. And this means we can target that high as well as all-time highs in the Nasdaq 100, and very, very similar in the RTY. This is looking like a higher low relative to this low right here. However, we do need probably another day or two of movement to the upside. Doesn't look quite as strong as the Nasdaq 100, but this chart does look relatively strong. All we need to do now is push up to this core resistance, that is the target, and then go break these highs and the new 52-week highs, or these equal 52-week highs we made earlier on in the year in July and August. Very, very solid looking chart in the IWM. And I think with solid macro and rate cuts on the table, I think small caps are going to do very, very well. I think mid caps are going to do very well. I think stocks in general are going to do very, very well. So there are your levels. 2180 for the RTY. That's where you want to set your buys. Our target 2275. The Nasdaq, our target is 20,400. You want to be buys at the 19,750 if you haven't already. And the S&P 500, you want to be buys at the 5,700 level. Aim for the 5,900. It looks like the most upside is in the S&P 500 market cap weight right now. The RSP looks good as well. If you can, you want to be buys here at the 176 and 172 area, although we never really got there and we're moving high. And this right here is all-time highs for the RSP. A lot of these indices are either making 52-week highs or new all-time highs, and their year-to-date charts look very, very good, very, very strong. You don't want to fight the trend. The trend is up. The path of least resistance is up. You want to hold equities, guys. Don't fight the trend. So looking at seasonality, we got some very interesting data. This is from Tom Lee's Fundstrat Research, and we see some very interesting things. They've listed very similar years to what we've had here in 2024, pretty much when the first 3 quarters have rallied above 20%. What are the forward returns in October, November, December, and for the fourth quarter? In every single instance, the average return in October tends to be very negative, -3%, median -2.5%, only a 22% win ratio. So in other words, the month we're in right now tends to be very, very volatile. We also see that the November, by and large, tends to be very, very positive. Median and average return 2.5%, 89% hit rate. We see the December period also very positive as well, up 2.7% on average, 78% hit rate. And we see the full fourth quarter tends to have an average return of 2.1%. But look at the median return, 4.1% median with a win ratio of 78%. October has been down 7 of the last 9 times. We've seen very similar returns, and that's why you want to buy the dip in October and just sit through the volatility. Volatility can rear its head, especially in a year that we've had like 2024. And here's a more nuanced version of what that'll look like. Generally speaking, we are right here. We tend to see a little bit of downward momentum into the October area. We form a bottom, and then we go on an end-of-year run, normally taking out those highs. Now, this isn't the S&P 500. We see a similar dynamic in the Russell 2000. This is where we are, at least on the 2nd of October, or where we were, and we can expect a little bit of a pullback in this October period, similar to the S&P 500, but we normally form a bottom right before the election day, and then after election day, we see a blistering rally into the end of the year, where we normally do take out the highs. And this isn't necessarily a crystal ball, but it does allow us to assess probabilities that market participants are very likely to buy a dip if we do get one in October. And that has to do with various dynamics in the market. Oftentimes, if we're in a bull market, we see collateral reinvestment into the new year in this November and December period. We also see a lot of tax loss selling in October, as well as a buyback blackout period that happens in October. And that sell-off allows the market to propel itself higher into the end of the year, into the new year. And the current bull market we're in is nearing the end of its second year. The S&P 500 has gained 60% since the lows we made in 2022. And normally we actually see the third year of a bull market. If it survives into the third year, the average return is about 13.1%. Now, the S&P 500's 61% gain puts it in the top third of post-war cyclical bull markets that lasted at least 2 years. Negative catalysts are generally required for a bull market to end in the third year. Large caps and growth have tended to outperform in year 3, but they are overbought generally speaking versus small caps and value stocks respectively. And if we actually go ahead, if we look at something like 1957, where the third year didn't continue, we actually saw a shallow recession. In 1966, inflation returned. In 1987, we had a shallow recession. But in periods where we didn't have a crisis or a shallow recession, and there wasn't a dramatic negative catalyst, the S&P 500 actually went on to return 13.1%. You want to stay bullish. You want to remain constructively bullish, because the probabilities do suggest we do go higher unless we see a major catalyst occur, sometime next year. And I think we had a lot to contend with this year, especially with the election coming up. And I think we're actually going to have a rather easier time next year, especially as the Fed is on the side of the markets easing monetary policy. And a positive catalyst for this bull market to continue next year is US share buybacks. Buybacks are looking very robust in 2024. This trend is expected to continue, and buybacks are officially eclipsing the 2022 and 2021 highs we saw earlier after the COVID helicopter stimulus money. This is very, very robust, very good. This is good for earnings per share, and it also does provide a supportive buying mechanism underneath stocks, and this is expected to grow about 15% in 2025. And the strength of share buyback authorization announcements in the US not only reflects a positive corporate outlook, but also acts as a strategy for optimizing capital structure and rewarding investors. This is just a sign of confidence from corporates, and they're showing investors the money. What could also be a very positive catalyst for stocks next year is the dollar. Both are actually bearish on the USD in the medium term into the end of 2025. They actually see the implied dollar forecast moving lower. That's good for corporate profits. A weaker dollar is normally good for company earnings because it reflects in a higher nominal amount on their income statements, on their balance sheets, and on their cash flow statements. However, how do you take advantage of these dynamics? Generally speaking, material stocks benefit from a lower US dollar. Stuff like materials, energy, and real estate benefit highly from a lower US dollar. The places you don't really want to be is discretionary staples, comm services, utilities, and financials. They actually benefit from a slightly stronger dollar. In fact, utilities and financials is kind of neutral. Stuff like tech, healthcare, industrials, real estate, they benefit from a weaker dollar. So anything with diversified international revenues, they would benefit from a weaker dollar, and all other sectors benefit from a stronger dollar. So if both its implied forecast of a weaker dollar into 2025 do materialize, you maybe want to have exposure to energy, materials, real estate, tech too, healthcare, and maybe stay out of stuff like discretionary staples and comm services. But this is one piece of the pie. There's also a whole bunch of other stuff to look at, and you can't just look at this in isolation. Diving into the macro, we got Goldman Sachs third quarter GDP tracking estimate. They revised it up to 3.2%, reflecting stronger than expected economic growth. This boost was driven by robust consumer spending, a resilient job market, increased business investments. The positive shift underscores the economy's ability to navigate the current challenges while maintaining momentum in key aspects. That's what Goldman Sachs had to say about this. Very robust, very strong economic growth, and that continues what has been about 8 quarters of very solid economic expansion for the US economy. No recession in sight. And while economic growth looks rather robust, inflation actually coming down as well. This is the 5-year break-even inflation rate, and essentially break-even inflations are a measure of what market participants expect the average inflation to be over the next 5 or 10 years. And as of Wednesday, the 5-year break-even was about 2.1%, which is pretty much at the Fed's target. And generally speaking, investors would grow kind of concerned the second this gets to about the 2.5% level. That would signal fear or a more sustained risk to upside inflation. And while we have seen an uptick here in the last couple of months, it's nothing really to be worried about because we're only sitting at about the 2.1% level. Disinflation is clearly underway. Break-even show that, PCE shows that, CPI shows that, and the market is still growing as a result. And the labor market after today's non-farms looks really, really healthy. The expectation for non-farms today was about 150,000. We got just over 250,000. We absolutely smashed expectations. The unemployment rate fell from 4.2% to 4.1% off its highs when it was 4.3% in early August, July. And all of this data, strong economic expansion, disinflation, and a jobs market that remains secularly tight, this to me just looks absolutely Goldilocks. And that's why we saw the price action we did today. And I think this solidifies that we're probably only going to get 225 basis points worth of cuts in the next 2 Fed meetings. But this economy is chugging along, and you want to hold equities in this type of environment because people have jobs. Immaculate disinflation is clearly underway. Growth is really, really solid. Equities do well in this type of macro environment, especially going into rate cuts, guys. You really do want to hold equities. stocks are going to do very well over the next year if we continue to see this Goldilocks data. But looking at next week, because we always look ahead, next week, guys, we get the FOMC minutes. Everything's going to happen on Thursday, Friday. Then we get CPI and PPI on Thursday and Friday. But inflation doesn't really matter anymore. It was last year's problem. I think we're going to see much of the same like we did with the PCE print. We're going to see inline figures that's going to continue the disinflationary path that we've been on for the better part of the last 12 to 18 months. But what really matters next week is earnings. Guys, Q3 earnings season officially kicks off next week, and we do have some pretty big names reporting. Pepsi is reporting Tuesday before the open. On Thursday before the open, we have Delta Airlines, Domino's Pizza, and then we kick things off on Friday. We have Fastnell, Bank7, BNY Mellon, BlackRock, Wells Fargo, JP Morgan. So we have some of these big financial names kick off Friday, and we also have a number of financial names the Monday thereafter. So I think the big focus is actually not going to be so much on inflation, because that was last year's problem. It's going to actually be the start of this earnings season, and the market's really going to be taking their lead from the earnings that we get here on Friday. Now, Q3 expectations, guys, the S&P 500 is expected to report 4.8% in revenue growth, so very solid revenue growth. Energy actually seeing revenues decline. Information tech, a double-digit increase. How does that translate into earnings? Not that great if you ask me. 4.6% is the revenue growth expectation. Look at energy, negative 18%. Lower energy prices really gonna hurt this earnings season. Infotech expected to see 15.6% earnings growth, and healthcare and comm services with double-digit earnings growth as well. So a fairly muted Q3 compared to Q2, but this is going to set us up for Q4. And this also makes it for an easy comp if these numbers do materialize for the year after next. Either way, guys, what we are expecting is 4.8% in revenue growth, 4.6% in S&P 500 earnings growth. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.